Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor here at ETF.com.
This week, we're talking with Howard Chan, founder and CEO of Kurv Investment Management. Howard, great to have you with us.
Hey, Howard, tell us about yourself and what you do at Kurv.
Yeah, my name is Howard Chan. I'm the founder and CEO of Kurv Investment Management. We are a ETF issuer, but also an asset manager for many different types of strategies. My background, I actually formerly led the effort at PIMCO to build the European ETF business. And prior to that, I was at GSAM Goldman Sachs asset management. And so when the opportunity to start something new, I actually asked many of my old colleagues at PIMCO who have left and done other things since then, see if they wanted to go at it again. And a lot of them said yes. So many people that I've worked with over the last few years all came together and we formed Kurv Investment Management.
That's great. So, Howard, I want to ask you about your ETFs. You have a suite of 6 yield premium strategy ETFs, very interesting funds you have. Can you tell us how they work?
Yeah, we call them the yield premium strategy ETFs, but in essence, they're a smarter covered call single name ETFs. Maybe I can just explain, since the 80s, investors and ultra high net worth individuals have been using covered call strategies to essentially generate some additional income in their portfolios. And so these strategies are very similar to those where we have an exposure to an underlying, for example, a stock or something like that. And then we write call options. We receive a premium when we write the call options that generates additional income that we distribute out from the fund. We do it a little bit differently. The fund can hold the underlying stock, but we also try to get exposure through what we call a synthetic long, which is we can buy a call option and sell a put option at the same strike that gives the same economic exposure as the stock, but it's more efficient, capital efficient. That maybe takes only 5% of the portfolio, and then the remaining 95 or so we can actually invest in yielding assets like a short-term T-bill, which is generating at 5.25%. And then the other component to a cover call strategy is we do right out of the money call option, and that generates some additional income, most of the income in the portfolio.
Are these purely income plays or do you get some performance from the underlying?
Yeah, that's a really good question. So we actually, in our strategies, look to balance income generation as well as price appreciation. So we write the calls. The option premium generates the income that the fund distributes, but we write the call a little bit out of money. So generally, I think for us, the sweet spot is about 5 to 15% out of the money. And the range depends on the volatility of the underlying stock. So for less volatile stock like Apple, it may be closer to 5 to 6% out of the money. For more volatile stock like Tesla, we would write further out, 14, 15% out of the money. And the idea is that at that level, we get pretty good premium from the call to generate income, but we leave a little bit of room for price appreciation. The 6 ETFs that we have out in the market right now, they're all technology names. They're growth stocks. So we know a lot of people who invest in technology names do want to participate in some of the price appreciation. So we try to balance those two components.
Are these short-term calls that you're using, Howard?
I think there's a few dials that the portfolio managers can make, right, in the cover call strategy. And one of the dial is the expiry of the options. Options do have a finite life, so portfolio managers have to decide how long do they write the option. We believe the sweet spot for us is actually to write 5 or 6 week calls and then we roll them on a monthly basis. The synthetic long that I previously mentioned, we actually roll them every quarter to reduce any transaction costs in the portfolio.
Based on the lineup that you have already, Howard, I'm assuming this strategy works best with a volatile underlying, correct?
It depends. What the cover call is trying to do essentially is to harvest this volatility premia that's in the market.
Mhm.
And so you're right in a sense that the stocks that have higher volatility do generate more premia. So for example, less volatile stocks like Apple and Microsoft were able to generate, between 11 to 13, 14% of distribution
Mhm.
on an annual basis. But for the names that are more volatile, like Tesla, we're able to generate upwards to 30% because there's more volatility premia to be harvested.
Now, why would an investor buy this instead of just buying the underlying?
Yeah, so an interesting characteristics, and we picked these first six as technology names actually very intentionally. And one of the main reasons is that as growth stocks, many technology companies actually do not distribute dividends, or if they do, it's very little dividends. And so, we know in the market there's a segment of dividend investors or people who are looking to, maybe towards retirement and looking for some sort of dividend distribution to supplement their income. Uh, Traditional dividend equity investors have had to actually contort the sector allocations in their equity sleeves because they generally have to underweight technology because it doesn't distribute dividends, and they have to overweight utilities, financials, and energy names. And so we intentionally focused on the technology names because now there's a way in which these dividend investors don't have to give up the growth sectors of the economy and are able to get some income. So they're making the trade-off a little bit easier in terms of getting distributions for their portfolios.
So, Howard, the yields that you mentioned certainly sound compelling. I think you said the Tesla ETF is generating something around 30% annualized. But obviously, there's some risks inherent with that. Can you talk about, the downside risks? Writing calls on single stocks sounds great, but single stocks, of course, can be risky as well. Why should investors consider this type of fund over another fund which offers similar strategies on, say, an index like the NASDAQ?
Yeah, I want to, obviously also, make sure I properly describe the characteristic of a cover call strategy. And a cover call strategy works well in an environment where you either don't see a lot of price appreciation potential for the underlying name or very steady price appreciation potential, because when you write the call, you are giving some upside to generate that income. I think the reason why somebody would look for single names is that um, right now, actually, if you look at a lot of the volatility embedded in indices, and even using VIX as an example, volatility for indices are actually at all-time low. But if you look at the volatility that's offered in single names, it's actually still relatively high. So you're able to generate a pretty good income. And I think for us, we often talk to our clients is that we have six of them. And it's actually interesting if you look at the return and volatility characteristics, if you buy a basket of these ETFs, it actually adjusts the Sharpe ratio, information ratio in your portfolio. It can help boost distribution on your overall portfolio and actually reduce volatility to your overall portfolio if you actually mix these ETFs in a basket within the rest of your portfolios.
Interesting. Howard, can you talk about which of the funds in your suite are in particularly high demand right now?
Yeah, I would say that the top three, obviously Tesla has a very high headline yield. So that has been one of our largest funds. But also names like Google has actually done pretty well. Uh, I think for Google, for us, it has been a Goldilocks scenario where we're able to generate pretty good yield while generating some good price appreciation. So people see the income as well as, the positive total return on those funds.
How popular have these been since you started rolling them out, Howard? And what's next? I mean, how far out can you go with launching these kind of strategies? Are you just looking for specific popular stocks, or see sectors, or give us an idea what your plans are?
Yeah, I mean, I think over the last maybe since COVID, there's been a plethora of cover call ETFs, right?
Hmm.
And I think both index and single names, and I think the reason originally started was, during COVID, the market wasn't doing well, so people wanted to clip coupons on their exposures portfolios. But after launching this, we also found that there's an increasingly big segment of dividend investors.
Hmm.
As you know, demographically, boomers and folks are well into kind of retirement, and people are looking for that steady income. And we've seen from feedback from a lot of clients, that's what a lot of them what they're using these exposures for. In terms of, going into the future, we actually, see these first six as tools in a person's portfolio. So I should maybe come back to is like the reason why we launched these has actually gotten feedback from advisors. For an advisor to implement these strategies, it's actually operationally difficult, and from a risk management perspective, also very difficult. There's a lot of overhead in it. So we at Kurv basically will, buy and make sure the option positions are correct. All the advisor has to do is just buy one share of the ETF, right? So it's for them very easy to get access. All they have to do is decide is like what names and what portfolio of names they want to have in their portfolios. And I think oftentimes what people kind of also don't realize is that when they want to exit the strategy, they have to unwind the position. So if you sell your call to generate, you have to actually buy that call back, and you have to undo all your positions. Now in ETF format, you can just sell a share of the ETF to exit the position. Now, we see these six as tools in the portfolios, and we have gotten a lot of feedback in terms of, well, sometimes we don't want to decide which names we want to buy. We probably want to delegate that to you. So we have some funds that we filed that answers that questions, and hopefully in a few weeks or months that we can talk more about this.
Absolutely. So last question, Howard, you mentioned you have six of these ETFs and you have six of the seven Mag 7, actually. The only one that's missing is NVIDIA. Is there a reason for that?
Yeah, like I mentioned, a covered call strategy is not great for all scenarios, right? So cover call strategies are great when either a stock is falling. Actually a characteristic of cover call strategy is that it has a beta or sensitivity less than 1 to the underlying. So if the underlying stock falls by 1%, a cover call strategy actually might fall less than that. And this is seen in our Tesla strategy, where Tesla's stock hasn't done so great this year, and we have followed the stock a bit, but we have actually outperformed it by about 5% because the beta to the underlying is less than 1. The one scenario in which cover call strategies really shouldn't be used is when you have a stock that is appreciating really fast within the span of the cover call that you've written, right? So we write monthly calls, and the scenario in which cover call strategies really doesn't work well is if the stock appreciated a lot within that month. And I will say that, NVIDIA obviously have seen a lot of price appreciation this year with the advent of, development in artificial intelligence, compute, etc. So I would say that you wouldn't want to write a cover call strategy on an NVIDIA stock. With that expectation that potentially there's more price appreciation to run. So it's not appropriate for all scenarios. And I think one of the questions I've mentioned is people maybe want to delegate the decision of whether to write cover calls, when to write cover calls, what exposure you want in your portfolio. And, we're hoping we can solve that question in future funds that we launch.
Fantastic. Well, we're going to have to leave it there. Howard, it's been an absolute pleasure having you on the show. Thanks so much for your time. Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.